Please stand for the pledge. I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
At this time, we will have a report from the superintendent.
Yep. So thank you very much, Mr. Myers. So tonight's presentation is a follow-up to last year's presentation when we did an audit of our reserve fund. I gave you one additional sheet today, the yellow sheet. This is one of the slides from the end of that presentation that Dr. Annunziato and Rich Daddio gave to us in the auditorium. And that's when they spoke about our current projected revenues, our expenditure budget, and what our structural deficit was, and what our use of reserves could have been at the end of the school year if we didn't make some drastic changes during the school year. So they predicted that if we spent the entire budget at $123.4 million, that we would have expended $6.683 million in reserves. So we have just finished closing the books through our audit. We have where we landed regarding finances and funds from last year. And Frank's presentation tonight will speak to where we landed at the end of the 2021 school year and our reserve funds going into the new school year. So I'm going to turn it over to him. He has the presentation. I'm just going to move to the side.
Thank you, Glenn. Okay, so as Glenn talked about, what I'm going to talk today, I'm going to give a brief overview first, just to explain what reserves are and why they're important. I know some of you know that already, but just a recap. And then I'll talk about the year-end results and the reserve activity. So you'll see it says projected. It's important. The books are finalized, but not through a review process through the audit firm. So I don't expect any changes really, but the books aren't completely done, so there could be the possibility of a change. If there were, I would send a supplemental schedule out. And then we're going to talk a little bit about our current and historical reserve levels, and then I'll end it with some future considerations. Okay, so what are school district reserves? So they're quite simply a legal way for the district to save money to finance future needs, such as like infrastructure, equipment, any other requirements. It helps us to avoid taking on additional debt. And it's also something that we can use through tough economic times to help mitigate the need to cut services. They're funded through three ways. So the primary means for funding them for most school districts is surplus money at the end of the year. You could also transfer some unexpended balances to other reserve funds. And you technically can budget them through the annual budget process. Which we haven't done and most school districts don't do, but it is an option. And then a reserve fund, I highlighted this because it's pretty important. It should be, it's not really a parking lot for cash. Like every reserve fund should have a clear intent or plan on why you're using that money and how you're going to replenish it in the future. And then lastly, reserve funds, there's two sources of legal ways that we can use it. So it's through general municipal law or New York State education law. So those are the two sources that there are specific funds that we're allowed to use. Okay, so why are they important? Like I said, it helps you short term to avoid cuts, but it's also very important long term. There's a compounding element to reserves where operational surpluses, they lead to funding your reserves, which gives you a lot more flexibility in terms of budgeting. And also capital planning, and that, again, it helps to reduce costs in the future, which generates more operational surpluses and has a compounding element over time. So that's really the key. And when we talk about operational surpluses, it's important to note that, again, fund balance and reserves is not revenue, it's a financial resource. So the only way to really generate that is true year-over-year revenue being higher than our actual expenses. Okay, so now this is our year-end results. If you take a look at the screen, so you can see the fund balance at the top, that's what we started the year with. So that's close to 26 million, 25.8. which is 21% of our budget. Next, I showed the budgeted revenue and actual. So you see, our actual revenue came in about $500,000 short. We had projected, if you had looked in on the supplemental schedule you have, it's probably closer to $2 million short. I have an asterisk at the bottom, which I'll go over to kind of explain that difference. And again, we budgeted to use this year close to $4.4 million out of our financial resources, which is about 4% of the budget. How we did on the expense side, we had $123 million. That was the budget last year. We actually ended up spending just over 118, so significantly less. And then your bottom line number, the important one, is operating surplus. So we did have a surplus this year, so it was close to $500,000, so it's $479,000. And that would bring your total fund balance to $26,303,000. So that's, again, 21% of the budget.
I just want to make a note here so it's not confusing. So with our budget at 123.4 and our expenditures at 118, you see that there's a 5.395 million. That shows that we under-expended our budget. The reason that the surplus is 479,000 is because we removed 4.396 million from the reserves to get to that 123. So you have to take that back out of the equation. So since that was coming out of our savings account, what Frank is explaining here is that we have the 4.396 million to put back in our savings account into our reserves, and an additional 479,000, which brings our reserves from the 25.8 million to the 26.3 million for this year, closing the books. And in the yellow sheet, what I was explaining to you is there was a chance that we could have expended 6.7 million of that reserve. So really, it could have been 25.8 minus 6.7 million, putting us around 19 million?
Yeah, roughly.
Or roughly 19 million. What we did was we implemented some strategies. We cut off the budget early. We had some savings on products that we purchased. And we also had some savings on TRS or ERS rates, because we estimate those as we go into the year. And we saw some additional revenue at the bottom that Frank has asterisked here that offset some of the unplanned revenue, or we projected more revenue. Remember, if you remember correctly, we projected more revenue than we actually got when we created our budget. So that was one of our deficits in the budget. So
yeah, very well said there. Yeah, it was both sides. So we cut significantly on those expenses, did a lot of reallocation, and on the revenue side, we see the big items I highlighted. It's the CARES Act, so we applied for and received $500,000 in CARES Act funding that we applied to the budget. And then we had one-off items of insurance recoveries of $250,000. And then we had some prior year expenses that we cleaned up through just more proper accounting practices that added close to 700,000. So we had 1.4 million of one-shot money, which helped to offset that big steep revenue decline we saw in reduced state aid. And we also still actually had some state aid that was down that we didn't recover. So that was about $500,000.
the 700,000 that Frank is speaking about is each year in June, you create what is a rollover expenditure account, which is called the aid fund in the summer. So you project what bills will come in July and August that are for the 2021 school year. So we made that prediction based on previous expenses, and when the expenses came in, we had 676,000 remaining that we could put back into as a refund of expenditures that we didn't spend in that A account.
Yep.
Can you explain that $5,395,000 again?
Yeah, so under the expense variance,
Right.
okay, so our budget that we went out with was 123.4 million, Dan.
Yes.
We spent 118.
Okay.
So that's the 5.395 that we have left.
Left over.
But of that 5.395, not all of it was really extra money, because 4.3 of it came out of our reserves.
Correct.
So we minus the 4.396 out of the 5.395, and that's where you get that 479.
And then I just got a stupid question. 26 million is left in the reserve. Why isn't it more if we had 25 million?
Because you're only adding 479,000. Because what happens is, really, the 25 million we started with, you would have to remove the 4.3 million. So really, we were already down to 21 million if we expended it, but we didn't.
Yeah, the simplest way to think about it, Dan, the 4.396, that's money that we said last year when the budget was passed that we think we're going to need to use our savings because we're not going to have enough money for our expenses. We didn't have to go into the savings because we had more revenue than expenses. So if you just completely disregard that because it wasn't used, the 479 is the difference between your actual revenue and your actual
What I'm
expenses.
confused again is the 5 million, we didn't spend the 5 million. Out
Right?
of that 5 million, $4,396 came out of the reserves.
Yes.
We're putting that back in the reserves.
Yeah, but we never took it off the line.
Yeah.
So that
Okay.
25 million
You never took it
really
from
would be
25.
minus 4.396.
Gotcha.
Okay?
Correct.
Thank you.
You're welcome.
Hey, Frank,
Say that.
did you say that we still had a structural deficit of 950,000 because of all those one-timers?
No, I would. It's a surplus. It's not a deficit. So I wouldn't say that we had a deficit. No. If we didn't have those, we would have had a deficit of about $900,000. Correct. If we didn't have them.
Right. So outside of one-time income shots that we got,
We could have had a deficit, yes, but there's also, I'll caveat that there was also a lot of one-time expenses that we had last year too, so
okay,
I don't think that we're at risk of running a deficit because we had a large amount of transportation expenses that won't be happening again and facilities expenses, so
true.
I don't think we're at risk of running a deficit.
State aid on it.
Correct,
We should be getting good transportation
Right,
next
right,
year
right,
because
right.
of how much we spent.
correct, yep. So we got hit last year with a reduced transportation,
And we have
especially
reduction
because
in
of prior year
transportation
shutdown.
because we didn't pay March, April, May, and June.
Right.
This coming year, we overexpended that code by almost 2 million. Therefore, we're going to see more revenue on the state aid side because that's an expense-driven aid. So we should have an increase in state aid next year in that category.
So I'm sure you guys are already thinking that we need to carve out that extra piece and use it for one-time things.
So what we were thinking was, from our last conversation, is how do we rope in maybe a lease for busing, for buses, right? So we're gonna, when we get the full state aid picture, because you never know, we could get the expense-driven aid increase and then all of a sudden have a foundation decrease and be budget agnostic.
Right.
And here we are planning, saying, hey, we're gonna have this, increase in transportation aid, we better put it to good use, and all of a sudden it comes out, oh, we got a $3,000 increase in aid.
Yeah.
So, we have multiple plans in our head of where we want to go. We're currently completing the ST3 that goes to the state by the end of October, that they then calculate our aid based on that report that Frank's doing now. Okay.
Correct. So the next slide just shows some of the reserve activity for the year. Now this is money that goes in and out of the reserves, and so what we put in again was what we're funding for the next year is our TRS reserves, so the teachers retirement system, up to the maximum amount. That's a new reserve that was established and first funded last year. It's capped at 2% of our TRS salary, so we funded that with the full amount. We replenished most of what we budgeted to use in ERS last year, so we budgeted to use 1,396, so almost 1.4 million. We're putting back in about 1.3. EBLAR, so our employee benefit liability reserve, $1 million, and again that's simply just a transfer because we're using less appropriated fund balance. And then workers' comp, about $700,000, because we have seen increases in that. I'm sorry, Dan?
Such a large increase on workers' comp.
So we've seen increases in claims and incidents with workers' comp over the back half of last year and the first of this year. And a lot of this it looks like a very big number because when we budgeted to use reserves, it goes in and out, but it doesn't have to go in and out the same way, right? So we put in, we budgeted to use 1.4 million in ERS, right? We didn't fully put all that back into ERS. I put some into some other reserves. So you can replenish reserves based on how it best fits our future expense needs. So that's an evaluation that's done at looking at the expenses of everything, of all these categories, and then what our balances are, and then we can move the balances within those reserve accounts. So that's why it looks like such big numbers, but that number in the corner, you see, is still 479. That's why I want to highlight that. Like, that's really what the fund balance is going up, is the 479,000. Even though we had a few $1 million worth of reserve transfers, it's the equivalent of transferring from one savings account to another within like a bank account. That's kind of the best way to think about it.
And we're currently evaluating our workman's comp expenditures. Frank has been going through and looking at the amount of claims and how many claims we're getting. So we're doing an evaluation of that, and we're going to start looking into some of those claims and what we can do to try to curb some of those claims.
That's because we're self-insured on that, correct?
We are, right?
I guess we must have looked into buying insurance on it. Is it cheaper, or I guess not?
No, I mean, it's cheaper to self-insure it. I mean, we have a cap policy on it, so God forbid, like, we have just huge claims. But it's cheaper to self-insure. We have the means to do so. We've just seen some increase in incidents that I'm looking into.
So can you just give the example that you and I were speaking about? Remember you gave me a snapshot, and you said, hey Glenn, over the last 10 days we had...
Yeah, so
Do you recall that?
Yeah, so last year, I think we had about 70 incidences, I think. So it's, you know, almost every other school day there was another paperwork.
70 claims in workman's comp in 1 year.
So I you know, it's high. So, and then I did like a 5-year look back, and you see it's trending up. So last year it was trending up. This year we've had, you know, probably, I don't know off the top of my head, but probably about like 9 or 10 already. It's concerning because you want to make sure they're legitimate claims, first of all, and you want to make sure if they are, that we're trying to address why they're happening. So we're looking really hard at that. I met with the company that administers the claims. We went over everyone that's on the files, all their incidences, and developed a plan to kind of scrutinize that more closely moving forward.
Are people able to claim COVID as workman's comp?
No.
These are, hopefully we collate information that gives us a plan of the types of trainings we have to do. So stepping off the back of a truck and hurt their back, hit their head while doing X, Y, and Z, stepped in a pothole so we're scrutinizing those so that to see, all right, what types of safety trainings can we do to ensure that there are less of these accidents that are occurring at work so that we're not paying as many claims moving forward.
And do we have many lifetime payments we're making on compensation?
We do have some. It's the majority of it is not. The majority of the cost is not that. It's doctor bills and lost wages. It's not like we have a lot of huge, big, heavy hitters that are driving that. And for perspective, it's about $800,000 to $900,000 a year. So you're coming close to $1 million a year you're paying on that. So that if that helps with the $700,000 we're putting into the reserve, try to keep it around 3 years worth of expenses to have as a safety net. With workers' comp, with this additional money, we're about between 3 and 4. We're about 3.5 years worth of at the current level.
Almost stupid question on the compensation. I'm sure the company that we deal with is offering these people settlements instead of paying them for lifetime. Or...
Yeah.
So what happens is, Dan, most of the time, it comes back much less than the person's out. So somebody can be out, I'm just going to use an example, for 40 days of work, and it's all workman's comp, and then workman's comp says, we're going to give you 27 days.
No, I'm talking about the lifetime settlement. Someone got hurt.
We have so few of the lifetime settlements.
And a lot of it too, Dan, is like there's specific. I don't want to go into too much detail because just people listening, I don't want to go into too much detail, but there's a lot of schedules that are out there based on like the injury, what it's done, and the people we work with. Yeah, they have a full. It's a pretty sophisticated claims department. They have legal resources that they know what they're doing in terms of trying to help us with that. Okay, so the next slide here was the last one I have with a lot of numbers. So I'm just going to go to the bottom. I wanted to show you every reserve account just so you have it. I'm not going to go through the detail on each one, but the reserve, I'm going to start from the bottom because I think it's most helpful. You see, again, we're at 21%. In the last few years, we've been hovering around that range. We dipped a little in 2019, but we've roughly been around 21%. You see our budget this year, it's 124,777, and there's our total reserves. We're at 26.3 million. And you see some of the movement, as I was referring to, between the reserve accounts. You see the EBLAR went up, the $1 million that I said, give or take, because there's also reserve interest in these numbers that we earn. And then you see ERS is down a little bit, and then the TRS is the other one that increased significantly, because that's one we want to build that up. So our teachers' retirement system, we spend over $4 million, between $4 and $5 million, closer to $5 million each year. So we only have a reserve balance there of 1.8, so it's less than a year. And a lot of our other reserve accounts are better funded. So that's always going to be our priority, to build that up, to make sure we have it if we need it in the future. You never know when TRS rates are going to spike. Right. And lastly, just some future reserve fund considerations. So the first one is what I talked about in terms of having maybe a written plan about what our goals are for a lot of these reserves, and what we're thinking about the desired percentages that we want to keep them at. It's recommended to be around between 15 and 20% total fund balance, 3 years on reserve account expenses, but that's something that we could always have a discussion about. And capital investment, so our capital reserve fund we do have, but again, once that, we have a lot of projects that we have in place, so that may be something in the future we want to prioritize. And lastly, additional reserve funds. So we do not have a repair reserve. That might be something you might want to consider in the future. Similar to a capital reserve, except it's for existing equipment. So you can't like build a new building, but you can repair an existing one. And it has a lot of flexibility, and similar to a capital reserve, and it would help to offset some costs in the future, so you wouldn't have to go out for additional bond work in the future, possibly.
So could that be something that is used when the track or field needs to be redone?
Repair.
Yeah.
Yep. Yep.
Could you give us, what the statutory cap is? Do they all have statutory cap?
For the reserve accounts?
Yes.
No, they don't all have them. So basically, I can go through them if you want, Bob. So we're the employee benefit accrued liability, the EBLAR. So really the cap on, it's not a statutory cap, but you should really be below your total liability, your compensated absence liability, which we are. So our liability on the books is about $8 million. So about $1 million below that. And that would be if all of our employees were to retire, the benefits that they would receive. ERS, TRS, basically all the way down through unemployment. They're all basically the same category. There's no statutory cap, except you want to be around 3 to 4 years, with the exception of TRS. That's the only one that does have it, and it's because it's a new reserve fund. So that one, there's 2 caps on that. It's 2% each year of your prior period TRS. So your TRS salary of the prior year, you're allowed to put 2% each year to fund it, and then up to a total of 10% maximum. That's the only one with an actual statutory cap of those, because again, it's a newer reserve. And our unassigned fund balance, that has a 4%, which we are at. So we're at 5% last year. We kept 1% extra because the uncertainty around COVID and possible state aid reduction. This year, I lowered it to 4%. So that's again why you have more money going into the reserve accounts, because it's coming out of unassigned and going in there. So it's more of a transfer than anything else.
Okay.
Thank you.
Any other questions for the board?
one more thing before you, I asked this before, before you were here for the other gentleman that had your spot. We have $26 million in reserves. Why can't we borrow out of that instead of us borrowing tans and bands and stuff like
Yeah.
that? He said we couldn't, I was waiting for an answer, a legal answer,
Yeah.
writing, and we never got it.
So, I don't, the answer is, you're not gonna, I don't think you'll get a legal answer that you can, but the answer is that there's no answer that you can or you can't. We do, and he did. So, the answer is we do. So we still need the TAN because we don't have enough to completely fund the entire year, but when our property taxes, when we're waiting for the property taxes to come in, we do utilize the cash that's in those reserves for cash flow purposes. So we do that already. We still need a TAN though.
I asked the last time, we were told no.
No,
Yeah, so we do,
Right?
it's funny, we had the conversation today because
Yeah.
What, are you bugging my rooms or something?
one of the things that we were conversing about today is that I don't want anybody to be fooled that there's $26 million sitting in a bank account, because that's not the case, because these are fluid cash flows. So when we open school and we haven't collected property tax yet, we're using that money plus a TAN to pay our expenditures. Then the money comes in, then we replenish, and then we do a project and we make a payment. Or a bill comes in for TRS or ERS. And for example, that capital reserve that has $2.3 million in it, that's the one where we still want to do a piece of equipment at the middle school. Remember, we were going to put a piece of interactive play equipment outside, and now that the outside is done, that's also the one you added to.
The blacktop.
You added all that to it. So we can meet as a building committee and start looking at what do we want to do to start with that funding in that particular capital reserve.
Didn't the bus garage come out of that?
The bus garage is in there now. Remember, the cost of steel has like skyrocketed. That's so out of our price range at this point. But we do have other projects that we put in there. The DeLuca, the pavement in the back of DeLuca, the piece of equipment for the middle school. So we can pull out that list and start having conversations at the building level committee and then come back to the board.
Yeah.
Yeah, I appreciate it.
So, and that made sense, the full answer, Dan, that on the reserves? Okay.
Yeah, why pay someone interest when we can,
Right.
Yeah, if we didn't do that, your TANs would be
okay.
significantly higher.
Thank you for the answer.
Any other questions from the board?
Thank you, Rick.
Okay, no problem, thank you.
So Jeff, the only thing we have is one action item under Roman numeral 4.
You want to shut this one?
Yeah. Thank you. Just slide everything in.
Do we have any, as it's a planning session, we just wanted to make it known that we do have a meeting directly after this. So if there's any question regarding this presentation from anyone in the audience. Okay, for 4, it says board, is that fine? You said board action?
Yeah, under Roman numeral 4,
I never received it.
you didn't receive a confidential schedule. Do you want to make a quick motion to go into executive session out back? I can fill you in, we can speak to Veronica, and then come back out.
Motion to go to executive session?
Right.
Okay, that's Mr. Caroleo and Mr. Shine.
Yeah,
So,
say all.
executive session right out back?
We can go right out. Everyone's in favor? Yeah, great. So we can just go quickly out to
I didn't receive that. No. motion to accept board action items.
Motion to accept the